Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
I am your host, Scott Henderson, and my co-host is Dr. J. You know, we get a lot of questions. Some questions make us think, other questions are pretty basic, but everyone needs a basic understanding to be able to find their way to financial freedom. And one of our favorite strategies is the infinite banking concept. I mean, Jason has been doing it for almost 20 years. I think it's 19 now. I've been doing it for quite a while myself, and we continuously add and stack our money there. So today we want to give you that basic foundation that everyone needs to understand why this is a good thing for not just you, but your family and generations to come after. So let's just jump in. So Jason, the first question we always get is, isn't whole life insurance a bad investment?
Yeah, that's a one I hear a lot, Scott, and honestly, it's based on a misunderstanding. The infinite banking concept isn't about investing in whole life insurance the way you might invest in a stock or a mutual fund or an income property. It's about using a properly designed whole life policy as a financial tool, as your own private bank. It's all about how you finance things. So when someone asks, isn't this a bad investment? I will pause and then ask back, well, are you comparing it to a high risk growth fund, or are you looking for a place to safely store capital, access it tax free, and grow it consistently? When they consider that question, I think they start to understand what really they're asking. So you see, you're not choosing IBC instead of investing. You're using it to fund your investments and keep control all along the way.
Yeah, I think a lot of people need to understand that the most basic way to look at it is it's a bank account for you. It's not necessarily the best investment vehicle out there, but it is an account that you can store and grow your wealth. A lot better than a checking account where you don't get anything. In fact, you get charged to store your money there. Question two, how soon can I use the cash value?
Great question. I get that all the time as well. Most people are shocked that they can access their cash essentially immediately. Now, it depends a little bit from insurance company to insurance company. Sometimes it's 30 days. But the reality is, for most companies, you can access your cash value immediately. That's once the funds are good at the insurance company for your first premium. So if you send in a personal check, that's going to be 7 to 10 days for that check to completely clear. If you wire it, it's next day. If you do an ACH, it's usually 72 hours. Now, think about this. This is not like a 401k where you're locked in until you're 59 and a half and praying, and I mean praying, the government doesn't change the rules. So I'll usually say to people, if you had access to 10,000 next month, tax free, and could use it for a down payment, business, or emergency, would that give you more peace of mind? That's what this system does. It gives you liquidity and control right away.
I should say as well as there's a different spin to this because some people ask it about, hey, I just barely set up a policy like what Jason's talking about. But then there's others like me who I give monthly payments, right? Monthly payments to paying my policies back. And that is accessible even quicker, correct?
Yes.
I, if I remember correctly, about 72 hours to a week. So that's something that you can keep in mind where it's something that you can turn your capital pretty quickly when it comes to that point. Question three, what happens if I take a loan out and don't pay it back?
Well, the first thing I'd probably tell someone is that you don't want to do that, right? Especially when the policy is very young and new, and especially if the person that's taking a loan is very young. Now, if we have a policy that's been seasoned for, several years or even decades, and the person that's taking the loan for, say, in passive income time, that might be okay to do that and not pay back the loan over time. But reality, here's the truth. you're not charged when it comes to the loan, right? You have complete control on how you pay it back. It's up to your schedule. Now, in the event you were older and you've been using the policy, using the cash values and loans and everything, and then you die, yes, the outstanding loan will be deducted from your death benefit. Yet, as you alluded to just a second ago, you like to turn your money. So you put your money in there and then take a loan against it. Put your money there, take a loan against it, on and on and on, right? And be able to use your cash in several different deals or going from here to there, a velocity of money, if you will, right? So you have to kind of take a step back and say, well, would you rather be borrowing money from a bank with their rules or from your own system where you make the rules? Kind of a mindset shift, but once you get it, you'll never think about borrowing the same way again. What would you say?
Well, I would say is you need to think of it like a loan. If you don't pay the bank, they take the property. And really, that's what it comes down to. This system will not work unless you follow the basic rules. Don't steal from yourself. Don't steal from Peter to pay Paul. Question
Excellent.
4. Does borrowing hurt the growth of my policy?
Not at all. You have to realize that your cash values stay in your account. You're never going to touch it. You're going to enjoy uninterrupted compounding for the fact that when you take a loan, you're not withdrawing your money. You are taking a loan against it, which means you are collateralizing your cash value. Your cash value is collateral for the loan from the insurance general fund, right? So you are able to enjoy uninterrupted compound interest from the day you make your premium until the day you die. It's really kind of powerful, actually. And that's one of the reasons why some smart people in the past have called uninterrupted compounding interest the eighth wonder of the world.
And there's an asterisk to this, right? There are some companies that are not designed for this type of policy. They will penalize you. If I remember correctly, when I was going through and just doing research, because I'm that kind of son that has to understand and get some other opinions rather than just trust dad. But there are companies out there where they won't let you do it. In fact, I've seen it as high as 10% on each deduction. So make sure that you're working with a qualified professional. Question 5. What if the insurance company goes under? Because it has happened in the past.
Well, actually, Scott, I'm not sure if I've ever known of a mutual company that has gone under and people have lost money. I think you could Google and find out if you can find someone who has lost money inside a whole life insurance policy. Now, there have been companies that have gotten in trouble financially. What happens at state level regulators, they'll start to step in and tell them what to do. In a worst case scenario, that company will be taken over or swallowed by a larger company, absorbed by a larger company, and everybody's whole life policy, the guarantees stay intact. That's why guarantees are such a big deal. Very, very few, if any, went under during the Great Depression, as opposed to thousands of banks that went under during that time. Most of these mutual insurance companies are very old, right? And they're some of the oldest and most stable financial institutions in America. And even some of them are older or came into being before the Civil War. Okay. And here's one thing that I'd love to point out. If banks trust these companies with enough to buy billions, and I mean billions with a B, of dollars of life insurance for themselves, don't you think there's something worth looking at?
Well, past that too, banks treat it on the same tier as gold. Right? There's
Absolutely.
3 tier 1 assets to a bank: gold, dollars, actual cash in the vaults, and
Right,
then
or
whole life
treasury bills.
insurance products. And so if the banks trust it, I guarantee you there's a lot smarter people than I am, but they know something that we don't. Let's just put it that way. So isn't it just expensive? I mean, what about the fees? That's one of the things that we hear a lot is buy term and invest the difference. And I know there's another question going on, probably will come up about that because we get that one all the time too. But what is it about these policies? Like, how should we look at uh, a policy that a whole life policy? I mean, is it expensive, and what's going on with those fees?
This is a very important question, and so let's talk about it a little bit because it comes up all the time. And some of the expensive, not expensive fees and everything has to be on a time frame. Okay. So yeah, there's an upfront cost to get a whole life policy started. That it's not a free ride, right? But you're not losing that money. You're moving it into a system you own. You're building equity from day one, and you're setting up a place to store growth and use it. Start that over. You're building equity from day one, and you're setting up a place to store, grow, and use your money with total control. Now, right after I explain that, the next thing people ask is, okay, so what's the minimum I can put into one of these? And I get it. That question usually comes up from a place of caution, maybe even fear. People don't want to get in over their heads, but here's the truth. Once you understand how the infinite banking concept really works, the question flips. It goes from what's the minimum to how much can I safely put in? That's a mindset shift. That's a wealth masters a question. Anyway, the wealthy business owners, real estate investors, high net worth individuals, they're not asking how little they can do. They're asking, what's the maximum I can fund into this policy without making it taxable? They want to pour as much capital into the tax advantage liquid private system as possible because they understand what it does. So, yes, there is a minimum, and we can design something that fits where you are today. But the better question is how we're going to talk about is the so yes, there is a minimum, and we can design something that fits where you are today. But the better question is one we're going to talk about in the next episode.
Can I just buy term and invest the difference?
Yeah, you've heard that over and over and over again, right? Buy term and invest the difference. I actually have a client who at the time said flat out, I wished I would have known about the infinite banking concept 43 years ago. And it was at that time that someone approached him and say, hey, you need to buy whole life. However, he was confident. He had just finished his master's and he was getting his PhD. He says, I'm disciplined. I know stuff about financial. I'm going to buy term and invest the rest. Well, what he says in the testimony that he gave me later says, I didn't anticipate the ups and downs of the market. I didn't anticipate, the costly mistakes with other things, but he was disciplined. And he said, going back and calculating, he would have been way ahead, right? Um, the other thing you have to realize is that term insurance is simply renting, okay? It's rented protection. It goes away after a certain period of time, whether that's 5, 10, 15, 30 years or whatever, and you get none of that premium back. You have a death benefit for the while. And here's another thing you have to realize. Term insurance is the most profitable product to the life insurance industry. That's why there's thousands of company out there that offer term life insurance. It's not as many that are actually offering whole life insurance. All the risk is basically gone because there's just very, very few of those policies that are paid out during the term. In fact, there was a study, I think it was by Penn State, that showed that less than 1% of all term insurance ever pays out.
Hmm. Yeah, I think it's important to realize is that it is rented protection. Term insurance is like running on a treadmill where the treadmill is going backwards, you run in place. You're not providing yourself a stable foundation to grow on. And that's what we're really getting at here is you need somewhere, you need a solid foundation. One of my favorite children's songs is he built his foundation upon the sand. And then later he talks about building his foundation upon a rock. And you need to build that rock for you to have a house that will stand and weather the storm.
I
But
thought really love that you said that, Scott. And that's exactly it. The term insurance, I often refer to it as death insurance. I mean, like you have accident insurance on your car, and you do your premium every year or every month, and it goes on and on and on, and nothing ever really happens until you have an accident, right? Same thing here. You pay the premium, pay the premium, pay the premium, and nothing ever happens until there's a death. Someone's got to die, right? And that's why I call it death insurance. And it isn't stable. It's a temporary thing, just like the shifting sand in the song you're talking about. Where whole life insurance, you're transferring the real risk to the insurance company, a company that's been around for 100 plus years, sometimes even 150 years, and they know what they're doing, and they're very, very stable.
Is this really tax free? And what happens if the laws change?
Well, as of right now, the IRS says you can access your policy via loans tax free, and the death benefit is income tax free. You're right. Could the laws change? I suspect they can. Congress can do most anything they want. Uh, but here's the real magic, right? This is governed by a private contract. It is not a qualified plan. It is not subject to required minimum distributions. It's not tied to the government rules that change every time Congress gets nervous. 401k rules, IRA, Roth IRA, they're changing all the time. I think there's something like 26 or 27 changes this year. And so when thinking about this, it's kind of much higher up on the hierarchy, if you will, that if Congress decides to make changes to this, it's a lot heavier lift. And so often I'll ask people, says, are you 100% sure Congress won't raise taxes in the next 20 years? Or would you rather use a system with private contractual guarantees, right? It's governed by private contract. In order for Congress to start to govern these, they would need to get involved in every private contract. The bureaucracy, that is such a regulatory nightmare, they're never going to go there. Oh, that's my opinion, right? So I like the certainty. I like the certainty this is going to be around and they're not going to mess with it. And that's why I love this. Well, let me tell you something else. It was been quite a while ago. I helped write a book, Get What Congress Gets. And I wrote the chapter about whole life insurance. And what I did is that I went and researched through public records all the members of Congress, all the members of the Senate, the Supreme Court justices, and the main people in the executive branch. And what I found is that the longer they were in government service, the more they had in cash value life insurance. Anton Scalia, for example, when he died, he had $1 million loan against his policy, which means he had way more than $1 million in cash value. The average, if you average it over all of them, was $348,000. Now, the vast majority of the people in the House that had only been there one term or so, they had nothing. Even first term senators had barely nothing. But people that had been there a long, long time, they had millions and millions on that. And I just don't see Congress making a change to something that's a loophole, if you will, for them. They know it's a great tax advantage and a great tax shelter. They're not going to change the rules to hurt themselves, in my opinion.
Yeah, it investing becomes a lot easier when those who have the ability to change the rules are on your team, or essentially you put yourself on their team. And for that reason, I highly doubt that the laws are going to change. Question 9. Can I use this strategy for my spouse or kids? And I would add grandkids.
Well, yes, that is exactly what I've done. I use it for I own 10 policies on me, on my wife, on all my 6 kids, and in the process of getting it on my first grandchild. Yes, this is an intergenerational thing, right? You can insure your children, you can insure even your business partner. What you're going to start seeing is, since this is such a phenomenal way of controlling the banking function in your life, of financing things, you're going to want multiple policies. You're going to want as much cash there as you can possibly get. I mean, ask yourself, is it possible to have too much money in the bank? Is it possible to have too big of a line of credit? That's what this is all about, the ability to finance things. And the cool thing is, when you finance things, you can just in the process of financing things, you can be affecting 3, sometimes 4 generations all at once. So this truly is how we build generational wealth. I mean, you know that, Scott, what we've been doing, how it's going to, your second one is on the way. And that second one is already in the years, when they're very old, is in line to be able to have a decent amount of money that's going to be income tax free based upon what you've done and what I've done.
Love that. And that's been our main strategy to do what the Rockefellers have done. Pass wealth on through the generations. And this is a perfect vehicle to do so. Okay, question 10. One of our favorite questions. Why haven't I heard this before?
I really wish I had a great answer for this. One of them might is because it's not profitable for big banks or Wall Street to teach you how to become your own banker. There's no real financial incentive for the media to promote it. And it's highly regulated too by the government. There's only certain things you can say, certain ways that you can advertise it. And frankly, there's a lot of advisors out there that just don't know how to structure a whole life policy correctly. I had a meeting with a guy today who's had his license for, I think he said 25 years, and he didn't understand this. Well, that makes no sense, and it goes against this. It goes. Yet, as I sat and helped him understand, his mind started to open. There's another example. It's been a few years now. There's a guy who had been in the life insurance industry, had an agency for 50 years. And he says, I thought I knew everything there was to know about life insurance. And I've learned more in the last couple of days about life insurance than I think I've ever learned. I mean, he was just becoming excited. Okay. Because the reality is when you start to dig, okay, you're going to realize is that how the wealthy have been operating behind the scenes for generations. Rockefeller, Walt Disney, Ray Kroc, big banks, they all use variations of this concept. So the real question, I think, really becomes, are you ready to stop playing by their rules and start over? So the real question is, are you ready to stop playing by their rules and start using their playbook?
Well, guys, we promised you 10 questions, but we've got one more for you. And this is one that's hotly debated right now. What are IULs and aren't they better? Because from a return standpoint or a non-guaranteed standpoint on paper, they look pretty cool.
Yeah, I get this probably. This might even be the number one question I get for the fact there's a lot of agents out there that are pushing IULs or EIULs or ULs or VULs, whatever you want to call it, right? And the reality is they sound really slick on paper. Okay. You might hear, well, get stock market gains without the losses. Sounds really cool, right? Here's the reality. IULs are full of moving parts, and the insurance company is essentially shifting the risk back to you as the consumer. Now, part of those moving parts are cap rates, participation rates, cost of insurance increases. And the reality is none of it's guaranteed. The insurance company can change the rules after you've already committed. Well, is that what really do you have, right? I mentioned, and I've mentioned, I don't remember if I mentioned it on this podcast, but I've mentioned it many times before. In the 19 years of doing this, when I ever find someone that has a UL, I'll say, let's get an in-force illustration. And every single time it illustrates or it demonstrates on the paper coming from the insurance company that it's going to crash, that it's going to self-cannibalize, it's going to die, and the people are going to have no cash value and no death benefit at a certain age. That's like, well, is that really what you want? Okay. Where the flip side is with the whole life, you get guarantees up front. You get stable growth, predictable results, and you know exactly what to expect. So I'm constantly asking, if your financial future depends on a contract, would you want one that's fixed and guaranteed, or one the company can adjust later to protect their bottom line? Of course, you know the answer to that.
Yeah, and I would even take it a step further. It's like if you have another agent that is saying, hey, you should look at this. This is really cool. One of my favorite ways to respond is ask them, would you buy a term policy? Would you buy a term policy and buy options in the stock market? Because at its basic form, that's what it is. And that's part of the reason that it cannibalizes itself is your term, the older you get, you become more and more risky. And so your premiums like skyrocket and go through the roof. And if your agent comes back and says no, then you've got your answer, right? And so again, this is not about, hey, what's the highest return I can get on this? This is about, let's lay a solid foundation and then we build off of it, right? We go buy the investment properties. We invest in the stock market or Forex or crypto or whatever it is. Once we have that understanding, we can build the structure. But this is not the point to make it all in one Swiss Army knife that takes care of everything. It's designed to be very, very specific and very, very solid. Well, guys, appreciate you turning in. We always like having you, and we hope that this has been helpful and educational for you. If you like this episode, make sure to leave us a 5-star review. It really helps us out. And if you want to connect with one of us, shoot us an email or hit us up on one of our social media channels. Always happy to talk.
Make sure you come back next time, because next time we're going to do essentially the same thing, except we have 10 questions that you should be asking, right? We just went through all the top 10 questions that we get asked, but no, now we're going to come back in the next episode and we're going to say, what are the 10 questions you should be asking?
Yep. So tune in next time. And remember that mastering your millions all starts with your mind and your team. Make sure they are the best. We will catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.